Welcome back, everyone. For today's stock analysis, we're looking at Verizon. And Verizon is this enigma that every once in a while I think will make a really great long-term investment. I mean, they're the number 2 largest wireless carrier in the US. They're in a business that has predictable recurring revenues. Your mobile phone and plan have become almost as important as any other bill that you have every month. They're invested heavily into their network and 5G capabilities. And I've actually been a customer of theirs for a long time, and I'm genuinely happy with their service. And while I don't have their 5G capability at my house because I'm in some magical dead zone apparently, about a mile from my house I get faster speeds in a moving car than I do with my cable internet at home. So yeah, that's pretty good. And then just last week, they dropped another 8% or so on the Wall Street Journal's investigative report about lead-sheathed cables and the potential impacts to Verizon and AT&T and other wireless providers. So that got me thinking, is Verizon at a price now and their business still good enough to where they might be a strong long-term buying opportunity? Well, let's find out. So Verizon's currently trading at just under $34, and it's actually up 5% this morning, but over the past year, they've been down 36%, which is obviously not great. Year to date, they're down a little bit over 16, and again, they're up 5 this morning, so that was closer to 20 before the market opened, so we'll see what happens. So if we look at the dividend summary, obviously Verizon has a dividend yield of 8.09%. They have a payout ratio of just over 51%. A 5-year growth rate of just over 2, and consecutive years of dividend growth at 18 years, which is pretty good. So let's look at the dividend growth a little bit more. So if we look at their dividend growth rate, in the 10-year, it's 2.39, 5-year, 2.03, and the 3-year, 1.99. And just right off the bat, those dividend growth rates are not good, and even worse, they're declining. So that's not really a great sign. And if we even actually look at what they've been for Verizon in the 5-year average, their current dividend growth rates are actually lower than their 5-year average as well. So overall, that's not really what I like to see, but let's keep going. So if we take a look at dividend yield, we'll see that their current yield is 8.09, which is pretty high. And if you look at their yield on cost, what you'll notice is that their yield on cost is lower than their current dividend yield. And what that usually means is that the price of the asset that you invested in has been going down. And you can see that on this yield on cost chart. If you buy today, you're at 8% or whatever, but as you go back in time, you see that your dividend yield on how much you paid for the Verizon stock is reducing, which what you really want is for that to be the opposite. Okay, let's take a look at profitability. So Verizon's return on equity is 24.44%. That's actually pretty good. And their profit margin's a little bit above 15, so that's actually pretty good as well, especially related to other companies in their industry. So that's actually pretty good. So if we look at the momentum tab, this is where I like to see how it's performed against the S&P 500 in total return. And Verizon has gained a total of 3.53% over the last 10 years compared to the S&P's 226%. That's terrible. Let's look at the 30. And so I know there's people out there who say you shouldn't look at previous returns because it's not an indicator of future returns. And while I agree with that, the reason why I always look at previous performance is I always want to ask the question of, has this stock ever outperformed the S&P over the past, whether it's 10 years, 20 years, or 30 years? But I like to ask that question because it makes me really think about, are the fundamentals of the business that much better or that much different now than they've been over the past 30 years? And if I can't really make that case to myself or make a really good case for that, then the question is, why am I even looking at this? So talking about their business, what I've read and heard from their CEO is that they've invested heavily in 5G and they expect that to drive growth. But they've taken on a lot of debt to do so. So that's a little worrisome. But they also talked about how they've recently updated their plans. They've made them easier to understand. And they expect them to be more profitable because they're going to earn more from the things that they call perks. So these are the add-ons that you add to your Verizon plan. And so they're expecting that to drive more revenue. And they've also talked about that they're planning to bring down their capital expenditures, which should really help with their free cash flow because that is eating into a lot of it. That's something to keep an eye on. All right, so let's jump into the spreadsheet and look at the valuation real quick. So they're trading at $33.90, which is just a little bit above their low for the last 52 weeks. So if we get into the cash flow yield, so just to be clear, the price to cash flow calculation that I like to use is basically cash from operations minus capital expenditures minus dividends paid. And the reason why I like to do that is because I want to know what the actual leftover cash is after they have to invest in maintaining their business and pay out the dividends that I already expect. And we've looked at these other measures already: return on equity, profit margin, dividend growth. So in terms of dilution trend, they're even. And why I look at dilution trend is because I want to know if a company continues to issue new shares of stock, which means that any amount of stock that I have loses value. Even if the price stays the same, the percentage amount of the business that I own gets less and less. So that's a really bad thing. Ideally, what you want to see there is the dilution trend to be down, meaning that they're buying back shares and they're issuing dividends, because that's a win-win for investors. Their economic mode is narrow, and in terms of performance, they have not outperformed the S&P 500, which we touched on earlier. And if we look at the mean target price of Wall Street analysts, it's actually at 43.48. So being that it's trading under 34 right now, even if you don't believe in Verizon, it seems like there might be a little bit of room there in terms of potential gain. But let's look at the actual buy and hold valuation, because that's what I'm interested in. So when I do a buy and hold valuation, it's basically a discounted cash flows valuation. So I'll walk through kind of how I do it. And so what I actually do with CapEx is I don't take the number for each year. I do a 5-year average, and I apply that to each year of cash flows instead of just the direct CapEx number for that year. And it's a conservative measure just to say, CapEx can be very different on a year-to-year basis. And this just gives me a 5-year average that I apply broadly to every single year of cash flows. So when I look at my free cash flow growth rate for the past 5 years and change, it's a little over 12%. So I'll use 12% of my starting growth rate, even though I probably think that's probably a little high. But at the end of the day, that's kind of what the growth rate's been. So I'll keep it there. I have a terminal growth rate of 2.5%, which is basically the rate of growth I expect it to grow in perpetuity. So I have a required rate of return of 12%. And some people might ask about this because it's basically the discount rate that I use for this discounted cash flow model. And a lot of people I see use a lower number. They use like 8%, 8.5%, 9, 10. So what I'm trying to know is this investment worth the alternative for me? Because to me, the alternative is I'll just buy the S&P. At least 12% is a 20% premium. And what I'm trying to say to myself is if I can get a 20% premium by picking stocks that are undervalued that I believe in, then that's worth the effort. And then lastly, I use a 20% margin of safety, which again, it'll calculate a fair value price. And if I want to just be extra conservative, then buying at 20% under that means I have a margin of safety for my investment. So after plugging the numbers, I get a fair value price per share for Verizon at $47.46. And obviously the current price is under 34. So there's quite a bit of opportunity there if you believe in that fair value price. And even with the 20% margin of safety, that would put it just under $38 as a buying target price. And it's obviously under that. So by this model, the recommendation would be to buy. Now, obviously, a discounted cash flow model isn't always an accurate measure for a company. So I do like to do a multiples valuation as well. And that's basically comparing the company against other companies in its industry, in its sector, or that it's kind of closely related to see just the relative price and if it might be undervalued compared to its peers. So a lot of people use price to earnings when they do the multiples approach. I prefer to use cash flow. Price to cash flow to me is just a better measure than price to earnings, just because cash flow is harder to manipulate with accounting tricks and that type of thing. So in this case, price to cash flow for these companies is really tough because you can see there's 2 of the 5 that don't even have price to cash flow because they have negative cash flow. So that's a little disappointing. And then you have AT&T, which actually is way lower than T-Mobile and Verizon. So it really kind of skews this whole thing to where the average and median cash flow is kind of in the middle, right? So it can be helpful, but in this case, the multiples valuation, at least with price to cash flow, doesn't really tell me anything meaningful other than, maybe wireless and communication services isn't the industry for me, right? Because if this is the price to cash flow that these type of companies are going to have, then I'm probably not going to be too interested in it. All right, so if we go back to our overall view, you can see that the buy and hold valuation is actually pretty close to the Wall Street analyst's mean target price. So that's kind of interesting. And then the multiples valuation here is obviously kind of way off. Overall, when I look at Verizon, the things that stood out as positives, obviously return on investment's a positive. I actually think their profit margin compared to their industry is actually positive. And in general, their valuation, it seems like they are undervalued, right? In terms of the current price that they're trading at and what the business is probably worth. Now, the cons are, when you look at the cash flow yield, it's not good. The dividend growth is really poor. And even though Verizon is a really important company, right? Like obviously being a top 2 wireless carrier in the US, they're a company that is not going to go away anytime soon. They're going to continue to have customers, have that recurring revenue, but they're also in a highly regulated industry. So for a company that's struggled to outperform for the past 30 years, like where is that actual growth going to come from? I'm not sure. And when you look at that previous performance graph, I mean, it really is the kicker. I mean, it hasn't been good for 30 years. What is different now that you think is going to change that? So just looking at that chart, if you're a long-term investor, you're probably just better off buying the S&P and calling it a day, right? Unless you're in retirement already and you really want to create an income stream and you don't care about a total return over the long term, then, having Verizon at 8%, may be pretty decent because it's likely not going to go away, right? It's an important company. It's not going to go away. And, 8% is a good yield. So in that specific case, it may make sense. Now, the other situation that may be interesting for Verizon is if you're just looking for like a short-term swing trade to where it's undervalued right now and you're expecting it to just go kind of back up to that fair value amount, then you could probably make some money. But to me, this looks like a value trap, and I wouldn't buy it for a long-term hold. I'll tell you what, though, anytime that I get the urge to want to buy this again, I'm just going to look at that 30-year chart and then go lay down till the feeling goes away. I mean, just yuck. Now, if you guys want to see a step-by-step example of how Verizon's dividend has performed against another stock, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you guys in the next one. Peace.